introduce myself first. My name is NORFATINI DALILI binti NASRUL AFANDI. My metric number is 06DHT90F2011. I'm from DHT1B and Podison Polytechnic. I want to share you about three concepts. First, objectivity, historical cost, and money measurement. Stay tuned. Okay, first I want to share you about objectivity concept. The objectivity principle is the concept that the financial statement of an organization by using an objective viewpoint when constructing financial statement. The result should be financial information that the investment community can relay open when evaluation the financial results, cash flows, and financial position of an entity. Outside, auditors need their clients to produce financial statement under the objectivity principle so that the auditors can use evidentiary method to verify that the information in the statements is correct. It is easy for a business to comply with the principle if it has an auxiliary cost achieving system. This makes it easy for auditor to locate information that supports the aggregate balance not in the financial statement. Another way of viewing the objectivity principle is from the viewpoint of the auditor. If an auditor recently worked for a company and has now been assigned to manage the audit of that business, he or she may not be objective about the resulting audit report, depending. Net historical cost. Historical cost is the original cost of an asset as recorded in an entity's accounting records. Many of the transactions recorded in an organization's accounting records are started at their historical cost. This concept is clarified by the cost principle, which states that you should only record an asset, liability, or equity investment and its original acquisition cost. A historical cost can be easily proven by assessing their social purchase or trade documents. However, historical cost has the disadvantage of not necessarily representing the actual fair value of an asset, which is likely to diverge from its purchase cost over time. For example, the historical cost of an office building was 10 million when it was purchased 20 years ago, but its current market value is 3 times that figure. Historical cost differs from a variety of other costs that can be assigned to an asset, such as this replacement cost, what you would pay to purchase the same asset now, or its evaluation adjusted cost, the original purchase price with cumulative upward adjustment for inflation since the purchase date. Historical cost is still a central concept for recording assets. So fair value is replacing it for some types of assets, such as marketable investment. The ongoing replacement of historical cost by a measure on fair value is based on the argument that historical costs represent an excessively conservative picture of an organization. Last, I want to share you about money measurement concept. The money measurement concept states that a business should only record an accounting transaction. It can be expressed in terms of money. This means that the focus of accounting transaction is on quantitative information rather than on qualitative information. Thus, a large number of items are never reflected in a company's accounting records, which means that they never appear in its financial statement. Example of item that cannot be recorded as accounting transaction because they cannot be expressed in terms of money includes employee skill level, employee working condition, expected resale value of all of the preceding factors are indirectly reflected in the financial results of a business because they have an impact of either revenues, expenses, asset or liability. For example, a high level of customer support will likely lead to increased customer retention. Company against retention and a higher propensity to buy from the company again, which therefore impacts revenues. Or if employee working condition are poor, this lead to greater employee turnover, which increase labor related expenses. The key flaw in the money measurement concept is that many factors can lead to long-term change in the final financial result or financial position of business. As just note, but the concept does not allow them to be stated at the financial statement. The only exception would be discussion or pertinent items that management includes the disclosure that accompany the financial statement. All of the preceding factors are indirectly reflected in the financial results of a business because they have an impact of either revenues, expenses, asset or liability. For example, a high level of customer support will likely lead to increased customer retention. Company against retention and a higher propensity to buy from the company again, which therefore impacts revenues. Or if employee working condition are poor, this lead to greater employee turnover, which increase labor related expenses. The key flaw in the money measurement concept is that many factors can lead to long-term change in the final financial result or financial position of business. As just note, but the concept does not allow them to be stated at the financial statement. The only exception would be discussion or pertinent items that management includes the disclosure that accompany the financial statements. Thus, is entirely possible that key underlying advantage of a business are not disclosed, which tends to underrepresent the long-term ability of a business to generate profits. The reverse is typically not the case since management is encouraged by the accounting standards to disclose all current or potential liability of a business in the notes accompanying the financial statements. In short, the money measurement concept can lead to the insurance of financial statement that may not adequately represent the future upside of business. However, if this concept were not in the place, manager could fairly and intelligibly access to the financial statement that have little seperti basics. From 2, 3.
Assalamualaikum and hi everyone. My name is NURSYAHIDAH binti AWANG Muhammad Din. My number matric 0CBAT 98 2015. I'm from class JT1B and from Polytechnic Polisen. Today I want to present about financial accounting. Firstly, going concept. Second, separate entity. Third, equal concept. Firstly, I want to present about the going concept of equity in place that the business entity will continue its operation in the future and will not liquidate or be raised. A company is a coin concept if not evidence if available. To believe that it will or will have to curse its operation in foreseeable future. The separate entity concept. The separate entity concept tests that we should always separating secret or record the transaction of a business and its owner. Otherwise, there is a considerable risk that the transaction of the two will become intermingled. Lastly, equal concept. Equal concept GAAP allows preparation of financial statement on equal basis only and not case basic. This is because under equal concept, revenue and express and with record in the period to which they relate, and not when they are reserved or paid. Application of equal concept result in equal reporting of net income. Example, asset, liability, and retainer earning, which improve analysis performed in financial presentation over different periods. Thank you for listening.
Hi everyone, my name is NORFATINI binti KAMRUZZAMAN. So today I'm going to talk about my financial accounting 1. Did you know about time period concept? Time period concept is business need regular progress reports. So accountants prepare financial statements for specific periods and at regular intervals. Time period have 5. First, daily for sales report. Second, weekly for gross profit report. Third, monthly for profit and loss. Fourth, quarterly and half for yearly profit and loss balance sheet. And last, yearly tax and annual company reports. Next, what is materiality concept? Materiality concept is material amounts may aggregate with the amounts of a similar nature or function and need not be presented separately. Materiality depends on the size and nature of the item. Accountants may exclude insignificant details in financial statement. Materiality concept accounting example, omission, misstatement could influence user of financial of statement. Next, consistency concept. Consistency concept means once an accounting method has been chosen, that method should be used unless there is a sound reason to do otherwise. Example, using the horizontal or vertical method to be prepared the income statement and balance sheet. If the accounting period for a firm is from January 1 to December 31, for the current year, the firm cannot simply change the accounting period for the next year to be April 1 to March 31. So that's it from me and goodbye.
Hi, my name is Muhammad TAHA, matric number 06D80 19F2039. Today I would like to talk about prudence concept. Prudence concept is a key accounting principle that makes sure that asset and income are not overstated and provision is made for all non-expenses and loss, whether the amount is known for certain or just estimation. Example, expenses and liabilities are not understated in the books of accounting. Next is substance over form. Substance over form is an accounting concept which means that the economic substance of transaction and event must be recorded in the financial statements rather than just their legal form in order to present a true and fair view of the affair of the entity.